Let's take a look at the overall stock market indicators. They're all over the map sometimes. You'll see on mutual funds, this is how we've actually changed as a nation. We look at percentage of households that have mutual funds. You'll see over here back in 2019, it dropped a little bit, but more people have access to a thing called a cell phone. Cell phone, you have a lot of stuff on there. We all have now an opportunity to have instant access to financial markets. Just pick up our cell phone and take a look. Click, you open up an app. You can see what your stock portfolio has, what your bond has. You can look in your mutual funds. We have instant access to a lot of things that we simply did not have prior to the year 2000. And even then, till 2010, a lot of these apps simply didn't exist. So you've seen a lot of different things. So it depends what you're out there for. You're looking at a variety of ETFs, exchange traded funds, we call them. So they're a small, narrow focus group of stocks. Okay, a lot of the ones you'll see out there, large US stocks, small US stocks, international stocks, those are traditional. And sometimes they have a teeny tiny niche we're looking at, like healthcare. And they'll identify themselves as that, or high yield bonds, or a single country. Okay, French bonds or French securities. You'll see stuff like that. Then you get some volatile things like commodities. You'll see the aspect of gold. You'll see precious metals. If we have an economy that people are worried about it going bad, okay, a lot of times you'll see a migration of people's money from buying stocks and bonds into precious metals as well. You'll see different things out there, and you'll see the different funds reflect that in the process. The Dow Jones Industrial Average, we call it the Dow. Okay, what it is, it's 30 selected industrial stocks. A lot of them aren't industrial at all anymore. That's where they came from originally. That's a good way to track a lot of the big aspects of what's happening in the market. And people use that as an indicator among the blue chip stocks. And by blue chip, we means it really draws from the high end stocks that are very valuable all the time. The S&P 500 takes the performance of 500 stocks traded on the New York Stock Exchange, and it's a very prestigious group to be in there to sit down and do that. And a lot of times people just buy a mutual fund or some kind of fund that just tracks the S&P 500, Standard & Poor's 500, about 500 different companies, and you actually can track it that way. That is a good indicator as to the market is going. If you pay attention at the end of every day, you'll see today the S&P 500 was up, down 1% or whatever. You'll hear those reports out there, and that'll give you a flavor instantly as to what's happening over here. Here's how the Dow has changed. You'll see originally there were 12, and it started out being a little bit industrial, American cotton, oil, American sugar, and now the current ones, at the time of this writing, is these 30. But you'll see them change because all these won't be here then in 10 years. They'll change in and out over the current Dow companies. So you'll see that. Some of the market's roller coaster, you have to be careful in that because there's a lot of indicators. Black Tuesday, the market lost 13% of its value. That's huge. You'll see over here, 1997, an economic crisis in Asia. Oh no, the world's going to end tomorrow. And by golly, it did. Oh, wait a minute, we're still here. I get confused. Okay, so you'll have different things. You'll hear everybody out there. Keep in mind, whenever you read the news, too often, news isn't really news anymore. News is perspective. So you'll see everybody having their own perspective, and sometimes they're out there primarily to make a market for themselves. So it depends. Be careful about what you're listening to. The financial crisis in 2009 had a huge exodus out of the stock market. There were record losses. We called it the Great Recession, and it burst a thing called the real estate bubble, which should never have existed. That was nothing more than a federal aspect of it as to how we dealt with loans. So you have that going on. So the real estate bubble disintegrated, and a lot of people lost massive amounts of money. And miraculously, nobody went to jail over it. So you see all the different aspects, and you'll see bubbles come and go. We had a dot-com crash back in the 2000, and that's when the tech stock bubble burst. 2009, the real estate stock bubble burst. You see different things happening out there, and it is a roller coaster. And if you ever wanted to get on something on a roller coaster, a lot of times you hold your hands up and just scream at the top of your lungs. You can do exactly the same thing in your own living room when you pick up your cell phone and find out that all your stock is down to almost nothing. Then you can really scream, and it's really, honest to goodness, terror then. So depends where you're at. Wall Street now, you'll see different activities out there, transportation, what happened out there. The town car then, now it's Uber. Okay, restaurants, 21 Club, now it's Subway. You'll see the world changes. You'll see also a lot of different things shifting in the economy. What we have today is going to be very different in 10 years from now. The best products being sold in 10 years simply do not exist in today's market. So you'll see a lot of changes happening on a regular basis, and you'll see the same type of thing that is changing a lot. One thing out there is called program trading, which is why I do not recommend playing in the stock market unless you're going to watch your stock every single day. It's a big deal. If you sit down and program your computer and you have some of your financial giants out there, especially your pension funds and your insurance funds that can play with $1 billion in a day, somebody sits down and says, okay, we got these 7 stocks over here. If this happens in the economy and this happens, and they program 7 set points in the computer. If this happens, sell, sell, sell. So all of a sudden, boom. And in a blink of an eye, they sell $50 million worth of stock and securities in the same area you have your stocks and your securities. All of a sudden, the market plunges because they sold all this in a matter of a moment. And you're sitting there looking, and I just checked my phone and I'm doing really good this morning. And by the afternoon, you have white hair or no hair at all because of the fact you tore it up, because of the fact you lost all your money. Program trading is your nemesis and will destroy you financially if you aren't watching on a regular basis, except, except you now have another advantage is you have AIs coming to your rescue. Now, I don't trust AIs because they only do what they're programmed to do, except for the fact that if you can sit down and program your own AI to have program trading working for you on an individual basis, you too can protect yourself from a lot of program trading. And that's an opportunity. And right now, there's not enough information out there for me to give you an intelligent report other than saying, here's an opportunity for you to avoid those market bubbles. When a market bubble bursts, a lot of people lose money. And in the securities field, there are winners and there are losers. If somebody's going to win, that means somebody lost. So be careful out there. You want to be the winner. And in the process, keep in mind that somebody else is losing in the process. It is pretty tough out there to make a living that way. I grew up in a household where my father on the side, he had a side hustle all the time. He was trading options and doing all kinds of crazy stuff. And he did relatively well on a regular basis. It's just every once in a while he lose it all as a day trader. So it's really kind of interesting. There's a cleaning up Wall Street. There's a thing called the Dodd-Frank provisions. It really gave the government power to seize and shutter large financial institutions on the verge of collapse. They pushed it a lot. We had a disaster here called the Silicon Valley Bank. It went belly up, and all of a sudden, the federal government exceeded its authority by giving people who took risk. It actually gave them money that was above the warranty amount. I'm a little bit surprised by that. But that being said, now they opened the door now for a lot of different reimbursement of banks that lose money. So we'll see what happens with that big picture wise. But you'll see the Dodd-Frank, there's a lot of changes around there with a concept of trying to make it safer in this big, ugly world called the stock market. Dow Jones Industrial Average, know what that is. S&P 500, the Dow Jones is 30, S&P 500 miraculously has 500, and program trading and market bubbles, those are all things to pay attention to. You don't want to sit down and be popped in that bubble when it breaks. That's not your goal in life unless you want to lose all your money in a matter of a day or two. So it can be very exciting. Program trading, I've always warned about it. It's always been my concern over program trading versus you as an individual. But the reality is now we can actually start programming our own stuff through artificial intelligence. There's more to come on that. So if you're out there, pay attention. But of course, this is an overview course. Do not take this and think you're going to be a millionaire. If you are, you let me know and give me some advice on top of that as well. So understand your stock market indicators. It may help you an awful lot to really create a good long-term investment portfolio for your financial future. Take care.